Welcome to Real Estate Coaching Radio, starring award-winning real estate coaches and #1 international best-selling authors, Tim and Julie Harris. This is the #1 daily radio show for realtors looking for a no BS, authentic, real-time coaching experience. What's really working in today's market, how to generate more leads, make more money, and have more time for what you love in your life. And now your hosts, Tim and Julie Harris.
Welcome back. Today's podcast is all about helping you save deals. Specifically, when financing fails, this is going to be your blueprint to save the deal. So we're going to be going through point by point how you can actually essentially save deals yourself for your own buyers, your own sellers, but also use this information if you are co-oping and the other agent maybe has an issue with their financing as well. All of these notes, and there are a lot of notes and there are a lot of details in said notes, are available to you if you subscribe to our newsletter. It's harrisrealestatedaily.com. harrisrealestatedaily.com is our exclusive newsletter where we publish not just that day's notes from the podcast, but also the podcast in a video. And I've been including a lot of other extra articles that have been that are written by our writing team. We did something on tariffs. We're doing a lot on the proposed Trump housing policies, of which there's going to be many things that are going to directly be related to you and your business. So make sure you subscribe, harrisrealestatedaily.com. It's free. It takes like 3 seconds to subscribe. Just drop in your email. And after you do over at harrisrealestatedaily.com, then you need to pop over to your main email and you need to double opt in. The link is below if you're listening to us on YouTube or all the other places. And the link to click to join the newsletter is down below, or you can just go to harrisrealestatedaily.com. Let's roll in Julie Harris.
All right, so financing fail, real estate agents and brokers, it's time to learn to save your deals. Stop letting them die. Stop giving up so easily. Deals go sideways for many reasons, and as such, there are many solutions to solving those issues. So use the guide that we're going to roll out for you on today's podcast to get your transactions back to the closing table. Make the commitment to not ever give up. Today's discussion, specific to financing being denied. What should you do about it? Whether it's your buyer, as Tim said at the top, think about this when we talk about these points from both sides. Sometimes you'll be on the buyer side, sometimes on the listing side. If it hasn't happened to you yet, put this into your brain as the what I need to know before I need to know it category.
But Julie, aren't most of these problems avoided if they're using our ultimate addendum that they get as part of Premier Coaching?
Yes, and I will refer to that several times in this
so when
podcast.
you guys hear us talking about the ultimate addendum, listen to the podcast that we did. Where did we talk about that? Last Friday?
I think last Friday, yeah.
Yeah, and we've talked about it many times before, and of course our Premier Coaching clients know what it is. But stay tuned because we're going to drill down on that in today's show. But really, the ultimate addendum will save your bacon 9 times out of 10. Even if you're a new agent, you cannot assume the other agent on the other side of transactions is going to know anything about financing, because probably they know less than you might give them credit for. Even experienced veteran agents, a lot of them have never actually learned about all the nuances that can cause a deal to die as far as financing goes, especially in turbulent times like this. I'll give you guys an example, and this is just an example to whet your beaks, so you'll be curious about the additional points. If you're in Washington, D.C. right now, and you've got a buyer that was pre-approved or a seller that was going to sell and then they were going to buy something.
Or even a tenant.
Yeah, well, that's true. Even a tenant. And they work for the government. And now all of a sudden there's all these things called lender overlays you've never heard of before. So they were pre-approved, ready to go. Rockstar buyers or sellers, say 60, 90 days ago. Now, unfortunately, you're going to find that nothing's really changed effectively. They still have a job. They still have income, all the rest of it. But now there's an additional lender overlay. A lender can put an additional essentially guideline standard filter on every potential buyer loan, in addition to what's required by Fannie and Freddie. So don't just say because someone qualifies based on what you read on Fannie or Freddie's website. Don't just assume your buyer's going to qualify, because the lenders put additional rules and standards on top of that, and they're entitled to do so, because what they're not wanting to have happen is any of the loans that they issue to go south, because Fannie and Freddie will make them absorb those loans or buy those loans back. And they lose obviously tons of money. So the moral of the story is make sure you're paying attention, and you got to be, in a time like this, especially if you're in a market like Washington, D.C., you have to be paying attention. Now, There's federal employees all over the country, but this is especially relevant for those of you in Northern Virginia and all the other markets as well.
That's right. And before you go thinking that, oh, it's not fair and how can lenders do that and maybe it's illegal, it's not. It's coming from their risk management overlords saying, you know what, we're not going to have that kind of loan. This happened during COVID with hospitality people, for example.
Okay, let's just give them some more examples how this
Sure.
is relevant no matter where they are.
Yep.
If you're in Southern California and let's say your town wasn't affected by the fires, or if you're in North Carolina and let's say your town wasn't affected by the hurricanes, what you don't know, which will adversely affect a lot of your transactions, is the cost of insurance is going to go through the roof. And maybe you're working with someone that was pre-qualified 60, 90 days ago. Now, what's going to happen is they're going to soon discover that maybe they cannot get homeowners insurance, or the homeowners insurance itself is so expensive and they still have to get it because they're not paying cash.
And it kills their ratios.
It kills the ratios, exactly. So these are all the reasons why you guys really have to be paying attention, especially in a time like this.
That's right. And rest assured, we personally have closed thousands of transactions over our real estate career and have coached thousands of coaching clients to meet or exceed their goals. So the following things we're going to talk about and the solutions to stopping the deal dying, especially with financing issues, we've done 100% of these solutions multiple times. And again, have coached clients to do the same successfully. I know of quite a few deals that are under these types of circumstances. So first secret, as usual, it's a mindset issue. Manage your mindset. Get off the panic button and into action. You still have a deal if the buyer still wants to buy and the seller still wants to sell. Your job is to get to work to solve the problems. Most deals do have a solution. Now, if you have a backup offer, and many of you still do have backup offers, know the facts before you just switch to that deal. If you don't have a backup offer, get a 2-week extension immediately so you can work on the problem and you'll have time to resolve those issues and still get to the closing table.
And again, this really is important because if you truly want to transact in any kind of volume, you're going to have to know, for example, you will have a buyer that got pre-approved with, Bob the lender, or Larry
the lender, of course.
Larry the lender, okay? So Larry the lender approved Bob the buyer, but what we now discover is that Larry the lender approved Bob the buyer with a particular loan program that no longer is the best fit for Bob the buyer. Maybe one of the reasons we discussed with regards to lender overlays or whatever. So you're going to have to become not an expert at lending necessarily, but you're going to have to become very well versed, because you could have a buyer that all of a sudden says, I can't get my financing. But the reality of it is they can't get their financing with Larry the lender. But if you were to take them across the way to Lucy the lender, you'd discover that they can get financing if they use a different program. But good old Larry didn't have that exact program that Lucy has for Bob the buyer. Hopefully you guys are following me on all this. I'm trying to break this down as if I'm
Exactly.
explaining it to Zoe.
No, that's okay. I mean, a lot of these guys haven't yet dealt with this. And the reason that we're doing this, a lot of listeners requested it and coaching clients, but remember that every transaction on average is worth $10,000 to $12,000 to you, not to mention what it's worth to your clients, buyers and sellers. So it makes sense that you would educate yourself on how to fix this stuff.
But educate yourself also on which lenders you're going to be referring your buyers to, because not all lenders are the same. Are they FHA, VA approved? How many loans have they actually done? Or have they just basically made their living doing refinances? Things like that. I'll tell you what the short code for figuring out who the best lenders are. Ask the best agents who their best lenders are.
Yes.
Ask the best agents, by the way, who their best home inspectors are, who their best appraisers are, if they have any influence on that, those types of things. But ask the agents that are actually not the agent that you happen to share a cubicle with.
And not a Facebook survey, please.
Exactly. Go to the agent in your office or in your marketplace that sells hundreds of homes per year. Find out what lenders, and it's always going to be lenders they use, and use their lenders.
That's right, because they've already been through the gamut, right?
Right.
Okay, so today we're going to talk about the 4 most common problems with financing and, most importantly, how to fix them. Note to self, legally, a lender must explain why a borrower is denied their loan. Find out the specifics. Now, they don't legally have to tell you, although most of the time they will, but if they don't tell you, they are legally bound to tell the buyer. They can't just flat out deny your loan was not approved. They have to actually explain it.
But so again, we have to always make sure we're providing the most information in the shortest period of time for these guys. Understand that lenders are not going to spend any real time on the file until you have actually spent hours and hours and hours finding a house for them, negotiating the contract, going through the whole process.
Including inspections too.
Yep, I'm going to say that again. Lenders are coached and trained not to spend any time, basically as little time as possible, actually getting your buyer completely approved. That's the reason the lender's letters for the most part are garbage, because they have not done the 3-merge credit report, because they have not verified the assets to close, not verified anything. And that's the reason it says VOE, verification of employment. Or they'll ask for all kinds of little things in these lenders' letters. Again, we're going to talk about the ultimate addendum here in a second.
Yeah, but that's why it dies at the 11th hour, is because they don't actually work on the file until you're about halfway through your pending time.
And that's the reason we coach you not to work with the lenders that play that lazy game. That's the reason we make fun of Larry, the lazy lender. Make sure you're working with lenders that are actually going to get your buyers completely approved, with the only subject to being the appraisal of the property that they end up going in contract on. Otherwise, dear listener, you're probably wasting your time.
Exactly. Okay, so problem number 1, down payment issue and or closing cost issues. Both of them are the same flavor. It's money out of pocket at closing, right? So there are some questions. Again, you can get these from the newsletter, but if it's a down payment issue, here's some questions. If it's not enough, well, how much does the lender require? And to Tim's point, if it's Larry the lender, maybe the requirement's different than Lucy the lender, or the different programs. And that leads us to our next question. Would changing the loan program change the requirement? Remember, it's important, if your deals are not going to die and you're going to save them, that you ask lots of questions so you can come to the solution. Is it possible to use gift funds to make up the difference? Sometimes yes, sometimes no. Can the borrower cash out an investment account, a 401k, or other form of payment to build up their down payment and or closing costs?
By the way, they don't always have to cash out, because that's going to make it so they have to pay taxes. They could actually borrow against their other assets. They could actually borrow against like stock they have, or if they have some sort of 401 or some sort of deal with their employer, they can borrow against that. So selling assets is almost always going to be, it's going to be harder for the borrower because they're going to have taxes. But if they borrow against this, there's no taxes on a loan.
Exactly. Okay, can the borrower get a cosigner to solve the problem, especially on first-time buyers? Sometimes that solves the issue. Is it because they're guaranteeing an appraisal gap? We don't have that as much as we used to, but that still is out there. Might the seller renegotiate? Okay, maybe.
So let's stop there. Okay, that's really important, right?
Yep.
All right. So let's say, for example, you're doing FHA, VA, government-backed financing. And let's say, this is especially true with FHA financing. Let's say the appraiser appraises the house and the house is now appraised. Your contract price is, $429, let's say. So that's what everyone's in contract on. The borrower's only got the money for the down payment, doesn't have the money to make up for any sort of appraisal gap. The appraisal comes in at $400,000. Well, let's say make it even easier, more realistic. It comes in at $410. But still, we're essentially the difference between the appraisal amount, the maximum amount that the lender will be allowed to loan, and the actual contract price is still $20,000. Now, that borrower is going to have to either come up with the money, the difference, the $20,000 in addition to their down payment, or they're going to have to walk away from that house, or the seller's going to have to lower their price, or some hybrid version of where a little bit of something is coming from both sides. Now, that's a lot to negotiate, and the seller's going to say, forget that, I'll just wait for the next offer. What they don't know is, and you need to explain it to them, is that with FHA appraisals, that appraisal sticks to that house for, I think, 90 days.
Depends, but yeah, 60, 90, somewhere in there.
Lenders out there, if you know the current regulations, please do let us know so we can let our listeners know. So that means if you, let's say you're a listing agent and that exact scenario happens to you and the seller says, well, we'll just go for another offer. If the other offer comes in and it's also an FHA deal, the appraisal that was just done is essentially married to that house for 90 days. I think it might even be 180 days, honestly. Yeah. That means that, guess what? Even if you do get another price that's more than the appraisal price, unless that buyer can cover that gap, the lender's still not going to be able to go over that certain amount. So once there's a lender, once the FHA appraisal is attached to that house, it's almost impossible to get, especially if you're an FHA, where there's a lot of FHA loans, your buyers are going to all be FHA, which means that seller's just going to need to lower their price. Interestingly enough, too, if you have a seller that has a rental property, this is off Julie's topic, but still relevant, and they don't know anything about the property, and they don't do the property inspection for them, they just don't know it, they never lived there, so legally they're not responsible. House goes in contract, house gets inspected, property inspection comes back with a bunch of, problems. The seller says, I'm not fixing any of it. Buyer walks away. The seller has to update their property inspection form, letting the world know that they do know about defects in the property.
That's right.
And that's true even if it wasn't a rental property. If it's a standard property, goes in contract, needs a roof, seller says, I'm not paying for the roof. Buyer walks away. Now the seller can't say they didn't have any knowledge about problems with the roof, right? In the property disclosure form. So you guys, that was not directly related to financing, but still important that you understand, because that's another great way to kill a deal. And if you got a seller that's trying to play hardball, you can always say, well, this is what the reality of it is down the road. Or if you're on the buyer side and if you have a seller and the listing agent doesn't realize that's what's going to mean, down the road, you now also are geared up for additional information that gives you more power.
Well, that's all true. And I would put all of what you just said into the bucket of exchanging buyers. From the seller standpoint, doesn't always solve the problem. You just have the same problem with a different buyer.
And it's going to be more days in the market, and chances are it's going to sell for less than the original list price because no one likes to buy milk that's been on the shelf for too long.
Which creates a worse problem for the seller.
Exactly.
Okay? But you've got to know these things going in so that you can properly counsel and advise your sellers.
Well, that's it. What Julie just said. Ultimately, that's what we're trying to do. We're trying to get you to be more knowledgeable so that you can help that seller or that buyer make the best decision for them. They're counting on you to know this knowledge. They're counting on you to be able to tell them the truth and the facts. By the way, if you don't want to deliver them the bitter pill that we're essentially asking you to do in order to be an ethical real estate agent, you can show them the notes from today's podcast or have them listen to today's podcast.
That's true.
We'll do it for you.
Yes, that's right. Okay, now the next 3 solutions to not having enough money to close. Again, that could be down payment. It could be closing costs. I remember one of them was they had down payment and closing costs, but they got it underwriting, and the lender said because you now owe this much on a credit card, it screwed their ratios up, and the requirement to close was that they paid off a credit card. That's all in the same bucket of not enough cash to close.
Right. Julie's giving you examples from one end of the spectrum, but there's I'm telling you guys, even on the more expensive loans, even the more expensive, well-heeled buyers, if they're not paying cash, they're getting financing. Some of the little micro changes that might be happening in we mentioned government employees, but there could be some industries that are government employee adjacent that also might be subject to some issues with buyers getting financing. And Julie touched on this, but during the housing crash, during the start of it really in 2000, I'd say early 2008, agents, it started in Southern California when this big mortgage company called New Century, which was a subprime mortgage lender, it failed. And as soon as that lender failed, all of a sudden, it started with Bank of America. They started pulling in agents' lines of credit and HELOC loans. So if you had a HELOC for $200,000, let's say, and you were in Southern California, but you only borrowed $20,000 against it. Well, your new limit, no matter how much equity you had, was only $20,000 because they weren't willing to take the risk that you were going to be able to continue to make the first payment, let alone the HELOC payment.
They basically froze your HELOC.
Exactly. Yeah. And so again, these are all the things that unless you've lived through it, you don't know it actually can happen, which goes down to the fact that you really need to be an expert at least highly knowledgeable, so you can advise your clients to make the best decisions.
As in being educated, motivated, and get into action, right?
Yep.
Yes. Okay. So next we get into the entanglement of ratios. I know some of you guys have gone through this, but didn't necessarily understand what this meant. So financing problem number 2 is the lender calls, usually the 11th hour. They just got through underwriting, but they don't meet the ratios. What does that even mean? Lenders require specific debt to income ratios to qualify a borrower for a mortgage loan. They calculate the buyer's total expenses divided by their gross income, which equals a ratio. That's why they call it the ratios. Housing-related expenses divided by gross income indicate how much somebody's income they're spending on the house payment. So typically, the total debt-to-income ratio should be about 36% or less, and the total housing expense should be about 28% or less. It depends a little bit on the borrower, their credit, their down payment, their purchase price. There's other things that go into it, but you cannot ignore ratios. There's no opting out of the ratio problem.
Julie, to the previous point real quick, I had a coaching client. I remember this was maybe 2 or 3 years ago, and they had a buyer that was going to finance, and this house was $8 million. And the buyer was going to put down 30%, but they were taking a portfolio loan against their stock portfolio. And the lender's letter didn't say specifically where the down payment was come from. It just had to verify that the borrower had sufficient down payment, and the borrower then sent the lender a picture of their stock portfolio, and the lender said, okay, that's fine.
Yep.
But they didn't ask whether the borrower was going to sell equity or whether like exactly where the cash was coming from and they didn't have the actual cash to make the down payment, the borrower is going to borrow against their existing portfolio. The existing portfolio, they had all their stock, all their assets were in like 2 stocks. Both these stocks plummet. So their ability to actually get out a loan from their portfolio essentially wasn't possible. And so there went their down payment. And this is all because Larry, the lazy lender, either didn't know how or didn't ask because he didn't want to put in the effort to figure out exactly what was going on with where those people's down payment was. And that is maybe a good time, or when you're ready, we can talk about
because it says that the down payment has been verified and they know where it's coming from.
It has to be in a separate account. And so in Premier Coaching, when you guys should all be joining Premier Coaching right now, you can join Premier Coaching for free. There's this thing called the Ultimate Addendum, which you should be sending every time. If you're on the listing side, you need to be sending it to the buyer. You accept the offer, full asking price, everything's great. Except, Mr. Buyer, you have 48 hours to comply with the elements in the Ultimate Addendum. All the Ultimate Addendum is, it's very drilled down specific things that you want that buyer to make their borrower actually do to verify they've got the loan. And the same thing works when you're trying to protect your buyer. Okay, so Julie, you have more facts on that?
We're going to drill down on some specific bullet points on that. So let me hover first on the ratio because it's related to what you're talking about. So again, they're comparing the money out versus how much of that is going to be your house payment and should you be able to handle that. That's all a ratio is. If ratios are too high, it just means the borrower has too much debt, creating too much cash flow out and not enough toward their mortgage payment. Now, this has actually become a lot more problematic because A, prices have increased, and B, ratio requirements didn't change along with the price increases.
But what's affecting the ratios? Remember, it's not just the payment or their other payments. It could be something that you're not really paying attention to. Homeowners insurance, we talked about that a second ago. It could just be some other erroneous thing. So don't just accept the ratios are screwed up. Find out specifically what the ratios are because you actually might be able to fix it.
The question is, what's screwing up the ratios?
Right. What's screwing up the ratios? And it might just be because, going back to our earlier points, that the lender has has overlays on the specific loan program that your buyers were trying to qualify for. And if they switch to a different loan program, maybe even a different lender, they would have no problems with the ratios whatsoever.
Exactly. Okay, and maybe they put a little bit more money down, which makes it better because their payment goes down. Okay, so how do you fix high ratios? Ask the lender. Again, we go back to don't give up. Don't just throw in the towel. The ratios are screwed up. I guess my deal's dead. We're not doing that. You're going to ask if any of these scenarios would work. The buyer pays off a fill in the blank, credit card, student loan, car loan, consumer debt, etc. Could they borrow from a 401k to do this? Could they borrow from the bank? Could they borrow from Bank of Mom and Dad to do that? Does the loan have to be paid off or just paid down? Okay, these are all questions that you can find in the newsletter. Would a different loan product have different ratio requirements? We used to save deals by turning an FHA deal into a 5% down conventional deal.
Well, if they have a whole life insurance policy, you can oftentimes borrow against those. And
That's
I got
true
news
too.
for you. You don't have to pay that loan back, basically. You're just essentially using whatever your life insurance would have paid off. So there's another option for them. You need to have all this knowledge, at least a cursory level understanding of this knowledge, so that you can make sure the lender's actually doing their job. It's super important that you take ultimate responsibility for protecting your actual client, but also you're going to have to be on the lookout for the co-op's client as well, because frankly, your co-op probably doesn't know even a tenth of what you've learned on today's podcast. If you guys want to learn more, and I know you do, and you want to take your business to the next level, you definitely need to be joining Premier Coaching. It is your source for all things that are going to be necessary for you to go to the next level in your real estate business. And Premier Coaching includes a daily semi-private coaching call. It includes lead generation, scripts, objection handlers, presentations, pre-listing pack, every single thing you can possibly need to build your business. You can check out the page over at premiercoaching.com and learn more about what we offer. And it's really important that you understand you can join now for free, and it includes full access to the first level of Premier Coaching, including a daily semi-private coaching call. A lot of you, thousands of you, have been involved with Premier Coaching for years, and I got a great new update for you. We have decided to include the Ethical Real Estate Professional designation with Premier Coaching VIP. You're going to learn more about that when you go over to premiercoaching.com. Ethical Real Estate Professional, if you want to check that page out, it's just ethicalrealestateprofessional.com. We originally were going to make that a separate product from Premier, but we decided to include it at no additional cost. So check out premiercoaching.com. All right, Julie, point number 3.
All right, problem number 3, credit score issue. Again, find out precisely what the issue actually is. Deal-killing credit issues come in 2 forms: low score and or a specifically damaging item like a tax lien or a default that's too recent. Find out what it is. In some cases, it might be multiple things, but find out what it is. If the score is too low by about 15 points or less, it is probably fixable with a few easy remedies. For example, you can use Experian.com to update credit and correct errors. You can do that online. Years ago, you'd have to write a letter and wait to hear back. You can do it all instantly online now. You can also use Experian Boost to improve your score with a few simple steps. If you can make, for example, a 698 score into a 715, you might be back in luck with the loan.
Well, Julie, talk about that because you did that for us.
I did it as an experiment.
Yeah, as an experiment in preparation for, actually it was a live event we were doing probably 3 years ago. Is that about right? Yeah. And tell them what you did.
Well, so I think back in the archives somewhere, we have a podcast that's all about credit, and it is included in Premier Coaching. Because everybody thinks, and to an extent you're right, that your credit score is based on making your payments on time and paying off your debt, not owing too much. That is true, but in fact, that's only about 20 to 30% of your actual score. There's other things that are involved, like the amount of time that you've even had credit. The credit mixture is a thing,
but Julie,
you can fix all this online very quickly with Experian.
But you did other things. You found out that if you put certain things like utilities on
That's
auto
Experian
pay.
Boost.
Tell them about that.
Okay, so here's how this works. If you, and again, you have to do this on Experian.com, and they'll actually walk you through it. It takes like 10 minutes, okay? So what you do, if you pay your utilities automatically, which most people do, either through your credit card or your bank account or whatever, you pay it automatically. You don't even think about it. Your gas bill, your water, whatever. If you give Experian access to see a history of those payments being automatic and never being late, that can improve your credit score within 7 days or less of something between 7 and 15 points.
That's insane.
And I messed with it, and that was true. And
Yeah.
you're not doing anything. You're not spending any more money. You're just showing them that you've been good. And what that is we don't think of like your water payment as credit, but it's showing that you make on-time payments regularly, and that does boost your credit score. That's why they call it Boost.
Unfortunately, believe it or not, guys, you're not the customer. Like the 3 credit reporting agencies, who's their customer? Who do they get paid by? It isn't you. They get paid by the lenders. So the lenders are their customer. The lenders, and if you think about, I know this, do lenders make more money when you have to pay a higher interest rate or less money? So the lenders are kind of not really in alignment with giving you the best loan. They want to give you a loan, but they don't necessarily want to give you their cheapest rate. And so if you know how to gamify the credit scoring stuff, and it is a game and the cards are stacked against
It's
you.
100% game.
It is. Anyway, as soon as you learn how to do that, you all of a sudden are going to be discovering your credit score will go through the roof. And you got ours up to what?
I had a perfect score for probably 60 days or so, and
850
it's
or
still
something?
840 to 850. It is possible to do, but you do have to make an effort on it because sometimes it's just something that's erroneous. When you log on to Experian, it tells you all of your supposed previous addresses, all of the iterations of your name or your names, and sometimes it's right and sometimes it's not. I once found somebody else's student loan on, I can't remember if it was your name or mine, but, Harris is a common enough name, and I discovered it because the address attached to it wasn't any of our addresses.
That's crazy.
You have to tell them that this wasn't me, here's my social security number, it's not me. So you might all be, I think it'd be a great homework assignment to just watch it. And
Julie, in credit,
Anyway.
it dictates everything, including your insurance rates.
Sure.
And everything is attached to credit nowadays. They do little soft polls where they're checking to see,
Yep.
and then they'll determine, like if you're trying to get a job someplace.
Yes, that's true.
And you're obviously trying to rent something.
I think security clearance for government people
Oh
is
yeah,
something-
but security
yeah.
clearance is the next level altogether. Yeah.
Yeah.
Especially if you have to have a higher level of security clearance.
That's right.
But listen, guys, the credit stuff. Now, why am I telling you this? What motivated us to talk to you about this? Because if you have this knowledge that we just shared with you, and you have a more drilled down version, just the surface versus the surface version we just gave you, and I'm not suggesting you get into the credit fixing business, but at the very least, now you have an ability to talk with your consumers about credit in a way that your competition can't. And if you want to know ultimately how you're going to differentiate yourself in the marketplace, it's not the number of videos you used to have on TikTok. It's going to be your level of expertise in being able to solve other people's problems. And credit, for most for most people is a problem, even if they don't necessarily know it is. What's your credit score? Well, it's been 780 forever. Well, here's an idea. I've got this list of things you can be doing. You can get your credit score up probably another 20 or 30 points, those types of things. And that will make an enormous difference in whether that actual, that customer, that buyers or sellers, whether they decide to use you, let alone, use you continuously for other transactions or refer other people to you.
Yes.
And that's available on premiercoaching.com.
Yes.
So make sure you join Premier Coaching.
Yeah, and it can affect whether they get approved at all, but also whether they get better pricing and don't have to pay points and stuff like that. Because to your point, it's the lender that, it's the person giving you the more credit that benefits.
We could talk about this. We've talked about this before.
In a twisted way.
It isn't a twisted way because the lenders make money when they charge you points. The lenders make more money when you have to pay a higher interest rate.
Yeah, they'll tell you, they'll get the truth in lending and they'll be like, your payment's going to be this because your rate is that. And the borrower goes, well, why is my rate a 0.25% higher than you quoted me? And the lender says, what? It's because your credit's 698 instead of 720.
Let alone, as soon as you get your credit score above 800.
720 is the magic number, but 800 is better.
800, 800, 820, 830. You can
push them around at that
exactly.
point. Yeah. Okay. Now, sometimes this is the last part of the credit point, and then we'll go into the fourth problem. Sometimes credit is not as high as it could be because there is a lien or something specific that needs to be paid off. A homeowners association back payments, a mechanic's lien. It could be an IRS loan. It could be a private loan. IRS debt. It could be possible, depending on who or what it is, to negotiate a lower payoff and not have to pay off the whole thing. Again, this gets back to asking good questions and knowing what the problem actually is. You're going to discover it's either fixable or it's not fixable, but don't just let the deal die.
Well, but let's drill down on that, Julie. So you might get into it. You might find out that indeed they have some unpaid debt to some, maybe it's an HOA, maybe it's back taxes from some state thing or whatever the hell it is.
Some old mechanic's lien from something.
I remember very clearly, Julie and I would have to actually sometimes, do it for them. I remember one in particular where we had to call the HOA who hated the seller.
I remember this one.
Who hated the seller. Absolutely. They wanted him to not just leave and move out because he had some big truck that pissed him off. But also, they literally wanted him dead. And so he had all these back HOA fees, and they were so irrational. They just wanted to foreclose on his house and just all this mean, nasty vitriol. And he didn't want to call them because at this point, he'd completely burned a bridge with them. So sweet Julie called him up and, got them to accept 5% of whatever was due on the back HOA fees and let the deal close.
She would talk to me, but not to him because
exactly.
they had Hatfields and McCoys going back and forth. It was crazy.
Yeah.
So sometimes it's something that is fixable.
Right. But if you don't actually know what we're trying to get through your head today, then you're not going to know that you actually have the control to fix deals too.
Yes, exactly. Okay. Point number 4. The buyer's home sale has tanked, and now they can't close on the new house. Take your backup offer if you have one and they qualify and they're not also contingent on home sale.
All right, let me say something here. All right, so I'm going to give you guys a couple of suggestions. First of all, if you are in a situation where the seller, let's just say, I'll keep it simple, right? So you've got a buyer who had a house to sell. They're in contract on another house. And let's even make it spicier. They're in contract in a house that you have listed, and obviously you're on both sides of the transaction. The one that you had listed, you're on both sides of the transaction, is $1 million. Okay, so right, there's some good money on the line, and the one that they have in contract is in contract with another buyer. Okay, well the buyer's financing falls out, and now your all of your commissions on all your deals and all your clients are just basically going to get tossed to the wind because the first buyer, they didn't get their financing. You didn't use the ultimate addendum. The buyer's agent on the buyer that was buying your client's house that they had to sell to move up to the next one, that agent didn't know what they were doing. They didn't have our ultimate addendum. You didn't know about the ultimate addendum until you joined Premier Coaching, so you had no way of actually vetting that. You guys get the whole point? This is the dominoes that kills many, many deals and takes the wind completely out of real estate agent sales. All right, so you need to have a couple backup plans in the event that happens. So let's say you want to, obviously the buyers still want to buy your listing. You still want to sell the listing to them, the whole thing. Have some backup plans with regards to investors that might be willing to buy their house. Mm-hmm. Because right now, if you, for example, are going to make, I'll just use, general numbers here. If you're going to make $60,000 on the house that they're buying, and you are going to make, let's say they're selling out of something that's $400,000, and let's say you're going to make $10,000 on that, and then there was a co-op commission, all the rest of it. There's room there for you to actually lower the price on the house that they had to sell and make it more enticing to a prospective seller or a prospective investor buyer. And I'll just even take this to the next level. You could also, and Julie and I did this too, and we've coached our agents to do the same thing. You could buy it. You could buy that house that was your listing that's necessary. Now, where are you going to get the money? Well, let's see. You're making $60,000 on the house that you're double ending. Plus, you've got the commissions on the house that they're selling that they were going to sell that they were going to pay anyway. So you now have more than enough money, probably in most markets, depending on what your credit is. See the previous point, to use the commissions from both the transactions to roll into the down payment to buy that house as a rental property. Now, obviously, before you buy the rental property, make sure that you're making the numbers work. So what we have, and we coach all of you guys to use, it's not a required part of our system, but we're definitely advocates of it, is we have a guaranteed home sale program. And it works essentially like what I just described to you. And we coach you guys how to use this in Premier Coaching. Again, it's optional, but we'll insist that all of you at least seriously consider doing it, because you can actually roll the commissions in from all these deals, and you can then basically buy properties with no money down. How do I know? Because we've had thousands of agents that have done it, and Julie and I did it. That's how we built our original rental portfolio, by doing exactly what I said. Now you're going to think, well, remember everyone's essentially netting the same. You're just the one that's basically facilitating all these transactions so this buyer can, buy the house that they want, and they end up walking away with the same amount had you actually sold it to a co-op buyer. You guys following me on all this? And if you don't want to do that, you don't want to take the risk, then have an investor or investors in your back pocket and try to make the numbers work for them.
But have it set up ahead of time.
Yeah,
this is not something to scramble with one day to closing.
Well, this is another thing that makes you really powerfully unique. Like, yes. I remember when you and I would go on, literally thousands of listing appointments, and the seller would ask about our guaranteed home sale program, to which you'd say, Mr. Seller, I'm so glad you asked. Here's the way it works. If you're moving up a house to a house that we have for sale, we'll guarantee the sale of your house. I think it was in 120 days.
I think we did a 90-day for a while.
Yeah, you're right.
But you have an option depending on your market, right?
We'll guarantee the sale of we'll guarantee the sale of your house in 90 days, or we'll buy it. And Mr. Seller would say, well, maybe let's say there was no other listing we had that they were interested in. They'd say, well, you don't have anything I'm interested in buying or moving up to. Remember, it's moving up to. They have to moving up in price. Okay, that's fine, Mr. Seller. Maybe I'll list something tomorrow or later today that it might be a good match for, but it's still relevant for you. Can I tell you why? And this is on a listing appointment. And Mr. Seller would say, yes. Well, let's say you're a prospective buyer and your house has a house to sell. And let's say there's 3 other houses in your neighborhood that they're also interested in selling, but they know if they buy your house, because they're buying it through me and they're exercising the guaranteed home sale for their benefit, and they again have a house to sell before they can buy yours, I'll guarantee the sale of their existing home. In other words, they don't have to worry about it selling. You don't have to worry about there being a home sale contingency. So when you receive the offer from that buyer has no home sale. But imagine how much more comfortable and confident that buyer's going to be, knowing that they don't have to mess around with getting the house sold. They don't have to wait around to hopefully get a number that makes sense. They can effortlessly move from their old house to their new house. Now, listing agents, prospective listing agents, when you're on a listing appointment, when you can explain this to the seller, why you have a guaranteed home sale, how it benefits them, even if they're not using it for their own, personal move up, you can show it as a advantage to prospective buyers. And this is how you end that little script. So, Mr. Seller, I want you to imagine you're the buyer, and the buyer's trying to decide between your house and the 2 other houses for sale. Your house has the guaranteed home sale. And again, in the buyer's mind, all houses are the same. These, yours and the 2 others, they could buy any of them, but they know buying yours, they don't have to worry about the sale of theirs because my guaranteed home sale. Doesn't that immediately make your house more desirable? And the seller, this one you're trying to get as a listing, is obviously going to say yes. You guys get it?
That's pretty advanced stuff, though, Tim. This is not usually podcast stuff.
But no, it's not. But that's an absolute knockout punch.
100%.
Especially in a competitive listing situation. Oh, I can never do that. I don't have the money to buy the house. You will learn in Premier Coaching how to create the money from the transaction to buy the house. Now, this will work a hell of a lot better, truthfully, on homes less than, say, $500,000, because then you can keep the properties as rentals, or frankly, you can flip them and make money on them. I will strongly suggest you keep them as rentals because, guess what? The Grow Rich Quick scheme actually does work. whereas the get rich quick scheme never does, right? Grow rich slowly through rental properties. If you've got a property that's good to flip, it's probably even better to keep long term. And with real estate inflating in value by, depending on your market, 5% plus per year, this could be a home run way for you guys to build wealth. And again, the down payments will come from the transactions. Full disclosure, everyone's going to know it. Everyone's going to see what the numbers are.
But they don't care because they just want to be non-contingent.
Exactly. They don't care. They want to be non-contingent. But when you're trying to, like for Julie and I, where it really truly worked, and for all of our top coaching clients, is where this is really powerful is when you're trying to win a listing in a competitive listing situation. And the other agents, here's what, they don't have a guaranteed home sale because their broker won't allow them to have a guaranteed home sale, or because they just don't understand how the math works. The math works when you use our guaranteed home sale that you're almost always going to have 20. If you end up buying it yourself, you're going to end up with at least 20 to 23% equity in the house, which is almost always enough for you to buy the house. You will not have to come up with any more cash.
Yes, but you should be ready ahead of time, get yourself pre-approved.
Exactly.
And if you're not going to do it, maybe you're in an area where that's just too heavy of a lift for you, price-wise. You can always find investors. All of you guys listening that are transactional at all have investors in your back pocket who are just looking for listings. And this is, when you do it from the front end during the listing presentation, that's currently an off-market property.
But Julie, think about this. If you could roll all the commissions back, and let's say you don't have the cojones to buy the house, financial or otherwise, and let's say you do have an investor that will buy the house. Investors will buy a house
That's what I'm saying.
20% off list price all day long. Most of them aren't even making margins anywhere near that. So you could, again, have a list of investors. Julie just said the magic thing there. Be pre-approved yourself. If you're even marginally excited and motivated, can you imagine, by listening to me say this, imagine if you're actually, competing for a listing for a $1 million, $5 million listing, or, even a $500,000 listing, and you've got the guaranteed home sale program. What kind of level of confidence are you going to have when you know that your competition doesn't have this? This is incredible. These are all the things we teach you guys in Premier Coaching. So make sure you go to premiercoaching.com and join ASAP. And just so you know, in the pre-listing pack that we give you as part of Premier Coaching and Ethical Real Estate Professional, the guaranteed home sale page is in there, and it's all explained for you, so you don't even necessarily have to know how to explain it. The guaranteed home sale contract is included in Premier Coaching, so you can see that as well, and you can see how all the math works. And you can change the numbers however you would like, but you have to do something. This is the ultimate risk reversal, and you want to know how to differentiate yourself in the marketplace. On all of your for sale signs, have ask me about guaranteed home sale as a writer on all of your signs.
That's right. And just because you offer a guaranteed home sale does not mean you're going to do it every time.
No.
It's just a unique selling proposition that we have this as a tool in the toolkit that most other agents can't offer you. This is one of the many things that makes me different and unique. Again, we go back to Premier Coaching.
I remember when you and I were selling real estate in Columbus, Ohio, and we were one of the first, probably the first in Ohio, to offer the guaranteed home sale. We're the first in at least Ohio to have a real estate team.
Yep.
We're one of the first, probably the top, like in the country. When we formed our team, there are probably maybe 100 other teams in the country, and most of which we learned from to start our team.
Yep.
Okay, but I remember you and I had put a guaranteed sign in a seller's yard. It was in Clintonville. Do you remember this?
Yeah.
Because it was so funny. And this other agent who had been in the business forever, her license number was like 1. You guys get what I'm saying?
0001.
Okay. She was so pissed
I remember.
that we were doing a guaranteed home sale program. She chased us down the street.
Yeah.
And we were just young whippersnappers or whatever the hell she called
We
us.
looked like we were 12 anyway. But
Yeah. And how can you be offering this? She didn't even take the time to learn it.
No.
But she was out of, well, I don't know if she's out of the business completely, but we never heard from her probably after another year or two because she wasn't competitive. And this is what a market like this is what knowledge like that. It gives you an unfair advantage. And if your competition, if you, dear listener, aren't going to be listening and applying the things that we're teaching you, then what are you going to do to be relevant? It's not more branding and marketing, I promise you.
No. And you guys work so hard to get to the point where you're pending and you're anticipating a closing, and your buyers and your sellers are so excited. The point of today's podcast is to inspire you to not give up. Don't just throw in the towel when the lender calls or sends you a denial letter, or your buyer calls in tears and says, I don't know what happened, but I'm not approved anymore. Or, the lender said that I can't follow this loan program, so they can't approve me. Don't give up. You have to save the deal. As we said at the top of the podcast, if the buyer still wants to buy and the seller still wants to sell, you still have a deal. You just got to figure it out.
Well, two thoughts. First of all, one of Julie's favorite sayings: "If it's meant to be, it's up to me." As in, if it's meant to close, it's up to you, dear listener. Okay, and number
that's really true too.
And, yeah, it is. And number two, you have to take ultimate responsibility to represent your clients. Right? You have to be assuming that you have to be protecting them. Like, we're giving you guys a whole bunch of rabbit holes that you need to be mindful of, that you don't fall into. But the real weakness is going to come not from you, because you're going to join Premier Coaching. You're going to learn about all the things at a high level that we're teaching you. It's going to come from the co-ops. It's going to come from the other agents. So, for example, when you, as a listing agent, when you receive that offer and the lender letter looks like it's gold-plated, it's not. I promise you it's not. Take our ultimate addendum, send it back to the buyer's agent, and say, listen, we super appreciate your offer. Everything's great. Right as rain. All the terms and conditions are great. But you've got 48 hours to basically comply to this ultimate addendum, or 24 hours. It shouldn't be that big of a deal because you're already working with the lender. And then that basically is forcing the lender to do all the verifications of, and the buyers. Most of the things in the ultimate addendum, let's just assume that the lender hasn't done any of the work. It will probably take the buyer or the borrower no more than maybe half hour to basically, here's a copy of my, the money I have in the account. Here's my verification of employment. I got my employer to sign it. None of these things take a lot of time.
I mean, let's say that you hit the jackpot and you've got a totally boilerplate letter that was just cranked out and they just plugged and chugged the borrower's name. There's been really no research done by the lender.
Which is normal.
Which is fairly normal. Okay, so they've done virtually nothing. They just gave you really just a pre-qualifying letter.
I mean, Larry literally got the call from the buyer while they were playing golf, or it came from, some online mortgage company. No work, no 3-merge credit report, no verifications of nothing. 99.9% of you are walking around thinking you have pre-qualified clients because these BS letters, they're garbage.
Yes. Okay, so let's say that's the scenario. In that case, and you're going to know when you can even accept it contingent on doing A, B, C, D, and E that are enumerated in the ultimate addendum, which essentially causes the lender to have to go deeper and gets them to basically do the underwriting job that they would have waited to do. So those are things specifically like, this is not the whole list, but not just go on a surface credit pull. Okay, they're going to do the tri-merge. They're going to get all 3 credit reports. They're going to average them. They're going to see what the score really is. Okay. They're going to do the math on the ratios and see how that stands up. They're going to not just take the buyer at their word that I have a down payment. They're going to verify it and know what the source of it is. That's a whole can of worms, home sale contingency, etc.
Yes, but I mean, we've already over half hour, but it is important. It's not just verifying they have the money, because those lender's letters where the lender is asking for proof that the borrower has down payment, they're going to get a letter from their lender, from the bank manager, or they're going to screenshot some account or something.
Proof of funds for the down payment.
Right, exactly. But that doesn't verify anything. Real proof of funds letter is going to be something operating at a different level. If the down payment is coming from the sale of the home, we've told you guys this many times, what lenders will do, and what frankly unscrupulous buyer agents will do, is they won't put the home sale in the actual offer, but the financing will be contingent on the home sale. So you'll receive an offer, no home sale contingency. You didn't know everything we've been teaching you. You didn't use the ultimate addendum. You didn't know the source of the down payment was the sale of their home.
Exactly.
There's nothing unethical. Well, there is something unethical about the buyer's agent not disclosing that there's a home sale. You just weren't skilled enough to make the lender and make the buyer's agent and make the buyer validate the fact that the down payment wasn't coming from the sale of a property.
I mean, they're technically kind of okay because it's contingent on financing, but dig deeper. Where's the financing coming from?
You accept a contingent on financing deal. After all, it's written into the buyer agent contract. It's normal, right? Well, okay, it's written in. It's just a box you check, contingent on financing, whatever. But the financing was contingent on a home sale, and they tricked you.
Yes. Now, let me say something about employment, because that's the last major piece of that. Okay, so verification of employment can be 2 things, and I've seen lots of variety to this. One is that the job exists. Okay, so that could be a pay stub, something like that. But depending, back to our previous point about, in this case, government jobs that could be at risk. Lots of people are getting fired. There's more than, hundreds of thousands of people being downsized right now. It may say, and we saw this in our career with different things going on with relocation, stuff like that it's not just the job exists, but they will ask for a letter from the employment that says that this borrower has a high likelihood of still being employed 2 or 3 years from now, depending on how they write it.
If the borrower has switched the type of employment,
Yes, this too.
okay, that's another
Length of employment, type of employment. This
Right.
is a can of worms, and lenders use it.
Yeah, well, because Larry the lazy lender was playing golf.
Yep.
Yeah, and he doesn't want to put any work into the file until there's a high assurance that he's going to get paid because the borrower is in contract on a house. Because they know emotionally the borrower essentially is going to be so committed to the house they want to buy that they're going to be willing to pay some points and get in all the paperwork in. So essentially the lender then has leverage at that point because the borrower is in contract on something and emotionally they committed to buying something. So the lender can start, playing a little bit of hardball with that borrower. I thought your interest rate was going to be this, but it's this instead. I can get this for you and you can still close in 30 days. And the borrower was going to say, well, okay, that's good. Well, guess what? Larry, the lender, now has increased his commission on that deal by a huge amount of money because that borrower is not going to go and shop them. I love lenders. Larry, great guy.
You just got to keep an eye peeled.
You just got to keep an eye on Larry.
Give him the side eye.
Lucy, I got news for you, Lucy. She isn't that much better.
It's not their fault. It's just how it's set up.
We're trying to be nice and diplomatic because we have some friends that are big lenders.
There are lenders listening right now.
We have lenders
throwing darts at our picture, no doubt.
We know somebody who owns one of the largest mortgage companies.
Yes, that's true too.
It's one of our neighbors, but
don't take it personally.
And he listens.
He does. Maybe not anymore.
No.
Anyway, let me kind of button all of this up too. And again, we can go way deeper into this. Every deal is different. Depends on if you're on the buyer side or the seller side. Depends on what the actual issue is. We used to have a saying that deals that had one of these problems wrong were pretty easy to fix, right? You could get that lien paid off. You could maybe put more money down. You could change something. The more challenging deals are when you have multiple of these problems at the same time, right? So the person owes the HOA a whole bunch of money and their credit score is like 10 points too low and they haven't been at their job that long and they're only putting 3% down. When you get a mixture of all of these problems, it's not that it's unfixable, it's just that it's going to take more of your time and effort. This is why you use the ultimate addendum, for example, to get through the woods earlier in the transaction. That way you have time to fix things.
Oh, I'm afraid to ask my borrower to do all the things on the ultimate addendum after they might not want to work with me because all the other agents in town will just basically go out and show them houses until the cows come home with not forcing them to do the work. Well, okay, here's a way to delegate that. Make the lender do his damn job to begin with.
Yes.
That's it.
Now let me just give a shout out to all of the great lenders out there because I hear about you guys on coaching calls as well. The best is to do all of this up front. The best lender letter, and we talk about this extensively in Premier Coaching, is one that says the borrower is approved for this address at this purchase price because maybe the boilerplate would have said they can go up to $500, but this house is $515. This house at this price, their employment has been verified, their credit has been verified and is adequate. This, that, and the other thing are not just in existence, but we have verified them. And on top of that, and I love it when I hear this from coaching clients, that same lender calls the listing agent, especially in a competitive situation, but they should do it all the time. Those of you who work with lenders like this, you guys all love them. They call the listing agent and then they say, hey, I'm Larry, the lender, and I'm vouching for Bob and Susie Smith on this house. They say that it's not just a pre-approval, it's loan commitment.
This is Lawrence, the lender.
Lawrence, the lender.
Okay, Larry, the lazy lender, and Lawrence, they're foes, okay? So Lawrence is actually going to do his job and do what Julie just said. Yeah. Larry, he's the one playing golf all the time. Golf. Exactly. Yeah. He's on Larry golf time.
Exactly. So, and I'll tell you, the lenders that operate this way, where they don't just do the boilerplate, they say, we've checked all of these things, and I'm going to give you a call. You can ask me any questions. Those are the lenders that have all the business.
So guys, listen, did we educate you? Yes. Did we motivate you? Hopefully. Now it's time for you to get into action. We've exposed probably a lot of things that you did not know about. You might be thinking, well, I don't need to know about those things. Well, if you're not transactional, if you're like 71% of all the agents out there who didn't sell a house last year, you're right. You probably don't need this information. But at least hopefully we educated and you motivated
Until you do need it, right?
Exactly. So the next natural step for all of you, you know what I'm going to say, is to join Premier Coaching. So just go to premiercoaching.com or click the link below. So guys, there it is. Now that is, again, just an overview of what we teach you in Premier Coaching. So do not delay. Go to premiercoaching.com. We'll talk with you on the show tomorrow.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.